On a humid evening in Jaipur, a family jeweler unlocks a glass case and places a heavy gold necklace in a bride's hands. Across the world in Shanghai, a young engineer walks into a bank branch, not to open an account, but to pick up two small gold bars he reserved on his phone. Neither of them's thinking about the London fix or futures in New York. They're thinking about marriage, security, and tradition. And yet together, these quiet purchases, multiplied by millions, help steer one of the most watched prices on Earth. That's the puzzle. Why do India and China, more than any other pair of countries, quietly move the gold market? Start with a simple truth about gold. There are two markets living inside one price. There's the financial market, derivatives, ETFs, macro headlines, and there's the physical market, bars, coins, jewelry, kilobars shipped and recast. Traders love the first. Households live in the second. India and China dominate that second world so completely that when their appetite shifts, refineries feel it, vaults feel it, and eventually even the screens feel it. In India, gold is not a trade, it's a habit. Across cities and villages, families convert savings into bangles and coins because it's portable, recognizable, and crucially, outside the banking system. Weddings aren't just parties, they're balance sheet events. Festivals like Diwali and Akshaya Tritiya add seasonal pulses, jewelers extend hours, premiums rise, and deliveries tighten. Rural incomes matter too. When harvests are good or crop prices firm, gold purchases rise. When the monsoon fails, they fall. That's not sentiment, it's household cash flow turning into metal. Policy turns the dial, raise import duties and official inflows shrink, a gray market opens through neighboring hubs. Cut duties or ease rules, and shipments surge through legal channels. The Reserve Bank can nudge banks' ability to import. The Finance Ministry can adjust tariffs, both ripple straight into shop counters. None of this shows up in a central bank press conference, but it shows up in the bar list at Swiss refineries and the flight manifests into Mumbai. China is different and just as powerful. Here, the state built a modern physical market on top of an old cultural instinct. The Shanghai Gold Exchange created a centralized venue for kilobar trading. Banks and refiners plug into it. Retail investors can buy bars as easily as a certificate of deposit. Capital controls keep domestic savings largely at home, so gold competes with property, stocks, and bank deposits as a way to store value. When housing wobbles or equity markets tire, small bars and investment jewelry move. The People's Bank of China adds another layer. When it accumulates reserves over months and years, it doesn't shout. It absorbs, quietly, in a way that changes the background weather without a headline thunderclap. Put the two together and you get a steady physical bid that does not care about weekly narratives. In soft markets, India and China soak up supply. In hot markets, they ration, premiums flip to discounts, and metal reroutes. This isn't price setting in the theatrical sense. It's ballast. It's what keeps a sell-off from becoming a flood and a rally from finding metal where none exists. Watch how the plumbing responds. Most of the world's mined gold passes through a handful of refineries that recast it into the shapes buyers want. Kilobars for Asia, smaller bars, and coins for retail. When Indian demand rises, Swiss refineries churn out more kilo bricks and shipments route through Dubai and Singapore before fanning into the subcontinent. When Chinese demand tightens, the premium in Shanghai nudges up, signaling to merchants everywhere that metal will find a better price behind the capital wall. Arbitrage takes over. Buy where the premium is low, sell where it's high, and the river of gold shifts course without anyone needing to announce a policy. Currencies add a second current. An Indian shopper doesn't see the gold price in dollars. She sees the price in rupees, with import duty and GST folded in. If the rupee weakens, gold looks more expensive locally, and demand can pause even if global spot is flat. It works the same way in China. A softer yuan can dampen purchases, a steadier one can unlock them. That's why local premiums are the truer heartbeat than the headlines. When you see sustained positive premiums in Mumbai or Shanghai, you're not watching speculation. You're watching physical scarcity express itself. Seasonality turns these currents into a rhythm. India's festival and wedding calendar creates predictable crests. Chinese New Year creates another. Smart wholesalers prepare months in advance, hedging future purchases, booking capacity at refiners, lining up logistics through Hong Kong and Shenzhen. If a macro shock collides with these peaks, say a currency scare during wedding season, the result isn't a smooth chart. It's a squeeze. Retail keeps buying, wholesale scrambles, futures wake up to a reality that's already true on the ground. Central banks are the quiet third force in this story, and in recent years the two countries at the center have mattered here too. When official buyers diversify reserves, they don't trade headlines. They accumulate ton by ton, quarter after quarter. India's Reserve Bank moves in measured steps. China's disclosures come in bursts. Either way, official accumulation has the same effect as millions of households. It removes metal from float and asks the market to live with less available supply at any given price. If you want to see these forces without living in a refinery, look at three signals. First, local premiums and discounts in India and China. They are the cleanest gauge of physical tightness. Second, policy levers, duty changes in India, import quota and VAT tweaks in China, any new channel for banks to bring metal in. Third, the calendar. If you're surprised by a demand spike during Diwali or before Lunar New Year, you're not watching the right clock. It's fashionable to claim that paper markets drive everything and physical flows merely react. That's true minute to minute. It's false cycle to cycle. Paper can sprint. Physical sets the course. The reason is simple. ETFs can be created and redeemed, futures can be opened and closed, but a jeweler in Coimbatore or a saver in Chengdu only buys when the price in their currency at their counter makes sense. When it does, they buy relentlessly. When it doesn't, they wait with equal discipline. Over years, that discipline carves the channel the faster money has to run inside. There's another softer reason India and China move gold: narrative memory. In both places, families remember inflation and devaluations in live detail, not footnotes. Gold is not an ideology, it's a coping mechanism. You can change product design, lighter pieces when prices rise, more 24-karat bars when trust in financial assets dips. But the instinct doesn't vanish. Markets built on instinct are sticky. They don't disappear when rates go up or down. They modulate. So what does this mean if you're trying to make sense of the next move? It means the global gold price is only half global. The other half is local, and the local half has a pronounced Indian and Chinese accent. If you ignore that, you'll chase headlines and miss the tide. If you learn it, you'll stop treating every tick as a verdict and start watching the plumbing. Premiums, duty, quota, calendar, currency. Imagine the Jaipur jeweler locking his case at closing time. Imagine the Shanghai engineer tucking two small bars into a desk drawer. They won't move markets tomorrow, and they don't need to. Their power is cumulative. 1,000,000 quiet decisions repeating across years, telling refineries what to pour and shippers where to fly. That's how two countries move a global market without shouting. Not with a press release, but with a habit. Not with a trade, but with a culture. And the next time a headline claims gold moved because of a line in a speech, check the counters in Mumbai and the premiums in Shanghai. If they're firm, the story is already written. If they're soft, the surge may fade. In a market obsessed with noise, India and China are the signal, steady, patient, and louder than they look.